Navigating the financial landscape. The role of corporate debt in assessing a company's health. In the intricate web of financial analysis, one of the key pillars that investors lean on to gauge the robustness of a company's financial health is its approach to corporate debt. The careful evaluation of a company's debt profile provides invaluable insights into its risk management, operational efficiency, and overall resilience in the face of economic challenges. Understanding the multifaceted role that corporate debt plays in this assessment is crucial for investors seeking a comprehensive view of a company's financial well-being. The anatomy of corporate debt. Corporate debt, often referred to as a company's liabilities or obligations, represents the funds borrowed by a business to finance its operations, expansion, or other strategic initiatives. This debt can manifest in various forms, including bonds, loans, or lines of credit. Unlike equity, which entails relinquishing ownership, debt allows companies to raise capital while retaining control. However, the judicious management of this financial leverage is essential for a company's long-term sustainability. Leverage as a double-edged sword. While corporate debt serves as a vital tool for fueling growth, it is a double-edged sword that demands a delicate balance. Companies that judiciously utilize debt can amplify returns on equity, strategically deploying borrowed capital to generate higher profits than the cost of servicing the debt. However, excessive reliance on debt can elevate financial risk, especially when economic headwinds arise or operational challenges surface. Consider two companies in the same industry, both with ambitious expansion plans. Company A takes on a moderate level of debt, prudently managing its financial obligations, while Company B opts for an aggressive debt-fueled approach. In a robust economic environment, both companies may thrive, with Company B enjoying higher returns initially. However, when economic conditions sour, Company B faces heightened financial stress due to its elevated debt burden, while Company A maintains a more resilient position. Debt-to-equity ratio as a barometer. The debt-to-equity ratio, a fundamental metric in financial analysis, encapsulates the relative proportion of a company's debt to its equity. Calculated by dividing total debt by shareholders' equity, this ratio offers a snapshot of a company's financial leverage. A high debt-to-equity ratio may indicate that a significant portion of the company's financing comes from debt, signaling potential financial risk. For example, if Company X has a debt-to-equity ratio of 1.5, it implies that the company has $1.50 in debt for every $1 of equity. This ratio provides context for investors, enabling them to assess how much of the company's operations are funded by debt, and whether the level of leverage is within acceptable limits given the industry and economic context. Interest coverage ratio. Navigating debt servicing capacity. The interest coverage ratio, another critical metric in the corporate debt assessment toolkit, illuminates a company's ability to service its debt obligations. Calculated by dividing a company's earnings before interest and taxes, EBIT, by its interest expense. This ratio gauges how comfortably a company can meet its interest payments from its operating profits. Imagine Company Y, with an interest coverage ratio of 4. This implies that the company's earnings are 4 times higher than its interest expenses. Such a robust coverage ratio suggests that the company has a healthy buffer to navigate economic downturns or operational challenges without defaulting on its debt obligations. On the contrary, a lower interest coverage ratio may raise concerns about a company's ability to meet its debt obligations from its operational cash flow. Maturity profiles and debt structure. The maturity profile and structure of a company's debt are pivotal considerations in assessing its financial health. A balanced mix of short-term and long-term debt can indicate prudent financial planning. While an over-reliance on short-term debt may expose a company to refinancing risks during periods of tight credit conditions. Consider Company Z, which has a well-diversified debt portfolio with varying maturities. This prudent approach shields the company from abrupt spikes in interest rates or refinancing challenges, as it can navigate debt maturities strategically over time. Investors scrutinize the debt structure to gauge a company's resilience to fluctuations in the interest rate environment and its ability to manage debt maturity ladders effectively. Industry comparisons and debt benchmarks. The assessment of a company's debt health extends beyond numerical ratios. It necessitates industry comparisons and an understanding of sector-specific benchmarks. Different industries have distinct capital structures, risk tolerances, and financing requirements. For instance, capital-intensive industries like manufacturing may carry higher debt loads than technology companies, which often thrive on innovation and agility. Analyze Company W in the context of its industry peers. If the industry norm is to carry a certain level of debt due to capital-intensive nature, a company mirroring this trend may be operating within acceptable parameters. Deviations from industry benchmarks may signal either a strategic advantage or potential risks that warrant closer scrutiny. Debt and earnings quality. While debt can be a catalyst for growth, its impact on earnings quality should not be overlooked. Companies may resort to financial engineering or accounting adjustments to meet debt covenants or project a favorable financial picture. Investors must discern between sustainable earnings growth and earnings inflated by financial maneuvers. Consider a scenario where Company M reports impressive earnings growth, but a closer look reveals that a significant portion is driven by non-operational gains or accounting adjustments. In such cases, the quality of earnings may be compromised, and investors should question the sustainability of the reported growth, especially if it is used to service a substantial debt burden. Conclusion. In the intricate dance of financial analysis, the role of corporate debt emerges as a critical and nuanced element in assessing a company's health. Investors, armed with an understanding of debt dynamics, leverage ratios, and industry benchmarks, can unravel the story behind the numbers, deciphering whether a company's debt profile positions it for resilience or vulnerability. As with any financial metric, the assessment of corporate debt demands a holistic view. Integrating quantitative analysis with qualitative considerations to paint a comprehensive picture of a company's financial well-being. It is in this nuanced exploration of debt's role that investors can unearth valuable insights, guiding them through the labyrinth of investment decisions with prudence and clarity.